So, hi everyone. We are now entering into 2023, and what we have seen in 2022 that the global markets, they had a lot of trouble. They had not seen the kind of inflation which emerged in the last year, and I think many investors, it was just a surprise actually in the developed markets. 40 years high inflation they saw. Still it is sticky, and now we are entering into 2023. So Indian markets, we all know that it has remained resilient. Our inflation was lower than US. Our bond yields actually remain lower actually when the interest rate cycle was picking up from May 2022 onwards particularly. And that was also one of the major reason for the resilience in the market. So let us see what is there now for the coming this particular month, January, and what can be the key themes now for 2023. This is all what we are going to discuss today in this particular webinar. So now the important thing is the dollar, which was continuously moving up, it is now getting topped out. This trend we have seen actually from October, November onwards now. Dollar index, which was around 115, now it has cooled off to 103, 104 levels. So this is a good sign for emerging markets, because when dollar tops out, we see that emerging market starts seeing some kind of FII flows, and because of which their currency also stops depreciation. It becomes a little more resilient. Some kind of appreciation is also seen because FI flow comes back. So that is what is expected. This is what the hope is going forward, that we may start seeing the FI flows in the Indian markets also. In the month of December, there was an outflow. We saw rupee is still sticky around 83. So going forward, it is possible that if dollar index remains lower, you will start seeing the FI flows coming back. So US inflation is one key trigger for this dollar index to come down, because inflation is cooling off in US. We have seen this much of high interest rate increase on a continuous period. On meetings after meetings, 75 bips of rate hike in US. We saw that finally it is impacting the growth, and some recessionary scenario is building up, which is leading to the decline in the commodities, and because of which finally we have seen inflation is cooling off. So we saw the period of inflation. Now we are worrying about some recessionary period in the US, and to some extent in Europe also now. So overall, at least this one problem of inflation looks like it is mostly behind us. And even if you look at the European gas prices, they are around 35 euros. They used to be at 70 euros. Now they are at 35 euros. So it has come down. But before this, for the last many years, they used to be 2 euros also. So from 2 euros, still it is around 35 euros, which is a problem for Europe. So it has come down, but still it is quite high in comparison to the last many years. And that is the reason this energy crisis in Europe is still, you cannot say it has gone off. It is still there. We had heard some industries were shut down actually in Europe. So we have to see how this trend pans out going forward. But at least the continuous fall in euro has been halted. And because euro had a high weight in dollar, almost 58% in dollar index. So when euro stopped falling, dollar also stopped rising. And this is what we are seeing in these particular charts actually here. So this is actually a good, comfortable, stable trend, which looks like at the start of 2023. Now, when I was talking about recessionary trend, so that is still there, because one of the indicator of 2-year bond yield and 10-year bond yield difference, if you observe in this chart, so still we are seeing it is around 60 bips. So it used to be in the initial period of 2022, or you can say the first half of 2022, around 25-30 bips. and it has widened to 60 bips rather. So this means that the recessionary scenario or the slowdown period in US can extend, and that is the reason actually the commodities possibly can remain lower. And this is directly impacting the crude oil, if you see here. So crude oil prices actually have remained lower. We saw very recently another 5% cut, and it declined below $80 per barrel Brent crude. And this is where I think when we look at from the Indian perspective, because we had to import crude, we have seen that first of all, the crude prices are lower. Second, India has imported crude from Russia in between. So Russian imported crude was hardly 0.2% till March 2022, and it has risen to almost 25% now. So that, and this is where India is in a good position from this perspective. So whatever exports are going to be lower because of slowdown in outside world, I think the import bill also will come lower. So trade deficit problem can be handled, which was a little problem actually to the market. So we have seen trade deficit going to $27 billion. But we also saw the trade deficit coming down to $22-23 billion also. So China is opening up. So I think from January 8th, many restrictions will be over. And that is the reason you have seen a spread in COVID cases also now in China. It is bound to happen when the economy is opening up. Cases will come. They will also see how they can deal with this. And that can create some volatility in the markets if it comes into other countries also. So till it is in China, markets may not be very volatile, but if it goes to other countries also. So we have seen in India, some cases are found from international travelers, the cases which are of new variant. So that can create some volatility. I think that can lead to more and more consolidation around 17,500 or 18,000 kind of levels for some time. And market can spend time here amid this volatility. But the thing is, opportunities are coming up. When China is opening up, you are seeing the steel prices also in China have moved up. So 8 to 10% of jump we have seen in the steel prices. Though aluminum remained lower, but steel has moved up. Steel, and that is the reason Tata Steel and all those companies, they look attractive. And it is possible that some kind of recovery can continue because of this opening up trade in those steel companies. When I look at Indian currency, INR, it is still sticky around 83. And you can see the reason here. FI flows, which were positive in the month of October and November, suddenly in December, we saw again it became negative. Though the negative number is not too sharp, what we used to see in the month of May, June, or in the month of September, it is lower, but still the flows which came almost of 46,000 crores in the previous 2 months, and when the market moved up from 15,000 to 18,000, suddenly that is stopped. And that is where markets have corrected a bit, and they are consolidating now around 18,000 levels. So when the Nifty valuations come into picture, we believe that if you see here, the EPS was consistently growing on quarter basis. Now we have seen that when you look at September quarter and then December this quarter, so it looks like that EPS is somewhere around 795 for Nifty. So it was 682 in September 2021 last to last year, and this September it was somewhere around 795. So it was a move of almost 16.5% in EPS. And during this period, we saw that the Nifty moved up from 17,700 to almost 18,100. So this means that price to earning, which was 26, because there was not much surge in the price in the last 1 year and 1 quarter addition, you can see of this quarter also. So prices have remained around 18,000. but earnings have revived by almost 16-17%. So price to earning has declined from 26 to 22.7. When we look at from the 1 year forward perspective, it was 20.8. Now it is somewhere around 18.6. So this is good that at 18,000 also, we are at 18.6 kind of price to earning when we look at 1 year forward. And if you see the last 5-year average, it used to be 18.5. So we are not too far now. It is almost there at 5-year average. So if somebody is looking for an investment, I think somewhere around 17.5, 18 is something, you can say it can be a good investment area if you are looking for 2 to 3 years of horizon, because short-term volatility can increase because of COVID cases and all. But my sense is the investment in this panic can be more fruitful actually if you look at for 2 to 3 years of horizon now. So this is what is happening. Government has been able to reduce their expenditure. They have been able to save more. So till now, from 0.2% in March, the Russian import, it has increased to 25% now by this year ending. And that is the reason government has almost saved closer to 50,000 crores in the last 6-7 months now. So this is a substantial amount, because when the government was giving PLI benefits, it was given to the tune of 1.97 lakh crores and 15 sectors were getting benefited. Now, if the crude is subdued, your trade deficit is in control. And then finally, we saw that you are able to save 50,000 crore. Ultimately, this will also go into the form of some reform or through PLI into some other sectors. So it will create further opportunities, stock specific, and it is going to benefit many sectors now. So this is what happening. When the government kitty is improving through this lesser expenditure, it is good. And next, the tax numbers. If you look at tax per unit of GDP, it is improving in India, because indirect and direct, both the taxes have seen growth. And particularly from the GST front, last year government was expecting 1.04 lakh crores. It happened to 1.24 lakh crores monthly inflow of GST. This time they are expecting 1.3 lakh crores. It is coming closer to 1.5 lakh crores monthly inflow. So it is surpassing again what government has budgeted, and that is where the cushion is there with the government. And the trade deficit and the fiscal deficit numbers should be around 6 or lower. 6.4% is what government had targeted. So this, from that front, I think the rupee should not depreciate, because the deficit number should remain in control. The only thing is that if FI flows starts reverting back, or if it gets slower, what we saw in December now, I think that will be a trend that can stop the further depreciation in rupee. This is another important number. If you see the petrol, diesel and ATF, these fuel consumption levels actually have seen a good growth. Generally, it used to be on year-on-year basis to 3-4%. It has come to almost 12-20%. So this shows that there is a good economic activity picking up. And we have seen in ATF, you are seeing the airline industry actually, the more and more people were used to travel. The corporates were opening up for business travel, etc., etc. And in petrol and diesel also, in diesel you are seeing the growth in SUV vehicles. Even I am seeing now, when we are talking about EV trend, Hyundai is coming out with a diesel SUV. And so the trend for diesel actually in the passenger vehicle space itself is picking up. I mean, CV and etc. So I think it is there for the diesel consumption perspective. So this shows economic uptrend, which is a good sign for India. Now I come to major themes which we believe are going to be very, very beneficial, and it leads to some stock picking actually in this particular year. So electric vehicle trend, though it is still slow, it has gone into two-wheelers where the more disruption has happened. Passenger vehicle, still SUVs are dominating the passenger vehicle space. And it's a mixed trend, because diesel vehicles are still there. Further launches are also there. But yes, the companies who are adopting EV and showing the path that how they are going to come out with vehicles in EV, they are going to be benefited. So that was shown by Mahindra, and we have seen how Mahindra has performed. That was shown by TVS. We have seen how the performance has come. I think a few other stocks from the automobile space, whether from the auto ancillary space or OEMs, can be looked at, who are more focused on the EV components or EV vehicles. So fossil fuel alternatives, this is something very, very encouraging. We saw in the G20 meeting also, Prime Minister spoke about that, in the previous meetings also, he spoke about that the target for ethanol blending, which was supposed to be 8% by 2022 ending, it happened actually in the month of March itself. 8% of blending. So this is something that the government is on a very rapid pace. You would have heard that the sugar companies, it's a proposal still, but going forward, it is possible the sugar companies, if this proposal goes through, they may start opening the retail pumps, and more than 20% of blending we may see at their end, and then that can be used in the tractors which used to load the sugarcane and all, and coming to the sugar companies. So that is a good revenue generation for those companies actually going forward, and their transportation cost of ethanol, because they used to send ethanol to the depot of IOC, etc., where the blending generally happens. So if it starts happening in sugar companies itself, then I think their logistic cost will be reduced and their new revenue stream will open up. So that is good actually for them going forward. Banks' credit growth, obviously, it has come to 17%, very encouraging. Last year, starting it was 5%, now 17%. So obviously, very good growth. And that is the reason that re-rating is happening in banks. We have seen the private as well as PSUs both have performed. Now the deposit growth is also picking up. And that is where the NIMs may not keep on expanding now. So over possibly another 1 or 2 quarters, we may see that NIMs are getting more stable. They may not be expanding too much because of the deposit growth rising. And but the larger banks, we believe, because of this credit growth cycle, they are going to be benefited. Their NPAs are in control. Their credit cost is in control. Provisioning we have seen somewhere reducing, which is coming into the PAT. And that is the reason going forward, you will see more re-rating happening in this space. And it is directly linked to the capex cycle, because when more capex happens, eventually the internal accruals comes to the rescue for the corporates, but then they also come to the banks. If you see, the fourth theme is the government infra spending. So the government in H1 financial year 23, they have fallen short with some kind of road construction. If you look at NHAI numbers, so 6,500 kilometers was supposed to be for financial year 23, but it came out to be 1,600 kilometers around. So there is a lot more to pick up, lot more ordering, tendering is going to happen from the government now. So infrastructure companies, road construction companies, they are going to be in focus till budget, beyond budget, and till elections. Because before elections also, we have seen some kind of infra pickup definitely happens, and that is where this sector will remain in focus. Rural distress remained the talk actually in 2022. We saw, because of higher inflation, the rural area, the products which are mass products, they were not able to perform much. So when we saw the commentary from HUL and all, so they were continuously talking about down trading is happening. The premium products are not getting sold, which was impacting their margins. Overall volume growth was coming down. It looks like that with inflation lowering in India, we saw it declined to almost 6%, closer to that. It is possible that the rural distress also will start getting bottomed out. So in that case, one can start focusing on some of the mass products also. So far, the trend is more of luxury segments in India, and these segments are performing better. The people who have more disposable income, so that particular trend is happening more. But yes, we need to see how this mass consumption or rural consumption or tier 3 consumption theme is going to pan out with lowering inflation. But that is definitely one of the trigger which we need to focus. Domestic healthcare expansion is there. It is happening. It's a good unorganized to organized move when we talk about hospitals. Limited hospitals are listed in India, and this trend is going to pick up more. Even in the pharma companies which are more focused on domestic, they are actually looking more promising rather than the companies who are still facing the price erosion in US. And so that is where I think the pharma trend is more of domestic and along with healthcare. And this is where the growth is going to come. Defense, we have already seen a good run in some of the companies. HAL, BEL, all of these companies, we have seen a good trend. They were all PSUs. Now the focus may be that because the government is sitting in good kitty, they will keep on announcing some defense capex, announcements of more indigenous items. In that case, I think some private companies which are entering more into this particular space, they will be beneficial. So because PSU's valuations have already seen some stretching, I think this benefit can go to those private companies who have not seen that kind of run up yet. So that is what we are looking at actually going forward. So whether it is Larsen and Toubro, whether it is Bharat Forge, etc., from the private space, which may be the beneficiary of this turnaround. Telecom, yes, it participated last year. 5G was announced, capex was announced, and then finally now the benefits have to be seen now once this is getting implemented. It is a big thing. It is going to bring many industries into the this canvas of telecom data uses, most speed network and all. And you will see, how the telecom companies' revenues can improve, and because they have already been announced or they have already been, given this freedom of increasing the tariff rates. So if you look at Bharti Airtel, they increased the tariff along with Jio previously, but again now they have removed this prepaid tariffs of 99 rupees in Haryana and Odisha circle, and they have moved to 155 rupees of prepaid, and prepaid is actually a very substantial amount in the revenues of telecom companies. So that is where the focus on from subscriber base to the active average revenue per user is picking up. It is continuously picking up, and that is going to be the trend in 2023 also. I think above 200 ARPUs very soon we are going to see now, and that will drive the stock prices. Consumer spending in luxury segments, that is a trend. We are continuously seeing whether it is jewelry, whether it is SUVs. So that segment is going to behave further because the income levels in that segment are better, and that the higher inflation does not impact that segment too much. So that discretionary expenditure is likely to continue. China opening up, I think metals is one segment where I discussed about steel prices moving up. So those companies can be beneficiary, and our 15% of steel export duty is also taken off by the government. That can also benefit actually those companies. So I think this is what the theme is for this particular year, and this is where the whole stock picking will go when we are looking into our portfolios. So finally, what kind of stocks, when we look at the consistent compounders or high consistent growth companies or the value segments, the companies which are moving from value to growth. So our sense is we need to keep a mix of consistent compounders as well as value to growth, because when we see 2022 and when we look at going forward in 2030, the GDP is going to move from $3.17 trillion to almost $7.9 trillion. This is what the broad consensus is. Market cap from $3.5 trillion, it can move closer to $10 trillion. I think some growth themes like digitization, unorganized to organized move, or which generally we call as formalization. India as a manufacturing hub, a good valuation. So we go with Maruti Suzuki now. We had bought Mahindra, if you remember, in our ACE equity portfolio last year, starting around 600. The stock got doubled. So that time we had an opinion that this company has a clear visibility towards SUV, EV space, and that really worked for them. Maruti was a laggard. They lost their market share in the last 2 years. And that is the reason the stock was underperforming. But we believe now, because the PV industry itself, the passenger vehicle industry itself, is growing very fast. And we have seen almost 10-year high numbers in a particular month, very recently. So it looks like the companies like Maruti, which are now going to come out with many launches till financial year 24 ending, they will come out with many launches in SUVs, which is in key demand, and they are also opening up the EV factory in Gujarat. So that is, I think, going to be the trigger now for the stock, which can limit the downsides. The stock used to be above 50 price to earning before, but after these corrections and time consolidation for the last few years, now the stock is available at 24 times. So I think this is where the valuations also are very attractive, and the stock possibly can start behaving now. So the margins trend is also reverting back. We have seen in financial year 24, it can be further better. Financial year 22, we saw it decline to almost 6%. So from 6% to 9-10% of margin improvement can be seen here. So overall, the story looks good to us. It's a market leader and available at a better valuation now. So if you look at Larsen and Toubro, this is another pick. I think the stock which should do good. It's a conglomerate. People have an opinion that why to look at this? We should look at one segment. So that story we also feel is better. But when we look at various kind of non-core assets which these companies selling off now, I think that is a very key trigger where the efficiency of the company is improving. The working capital to sales in the previous years, it used to be 24%. Now it has come down to 20%. That shows the efficiency is there. The Hyderabad metro problem, it looks like they will start selling it off. They had already gone for some kind of reserves for it. They had kept 2,000 crores of actually reserve for that. And now we are seeing the ridership is also increasing over there. So that problem looks to be getting solved actually for them now. And another key trigger overall, the macro perspective is that going forward, as I discussed, the more tendering is going to happen from the government, which was a laggard in H1 when commodity prices actually were very high. But now when you are seeing average prices being lower, that particular activity can pick up. So this company order book, if you see for H2 financial year 23 and going forward, so 6 lakh, more than 6 lakh crores of orders are expected, where 5 lakh crores is coming from domestic, 1 lakh crore is coming from international. So very, very strong perspective. Middle East orders have also increased, and that is the kick. And you look at the CAGR growth that we are expecting of the revenue CAGR, it looks like 15% of revenue CAGR is very much possible with an ROE of 18%. So infra company giving you ROE of close to 18%, efficiency getting better, profitability increasing, and the government impetus before the election. I think these are the key triggers for this stock and now going forward. So that is all we have for you for January 2023. I think that is what we should expect. And yes, beyond this also, all these things what we discussed, they are going to be a beneficiary. So this is what the whole trend is. And I think I am getting some questions now. Let me cover up some questions actually on YouTube, what we have received. One question is, how do you see the interest rate cycle going from here? So let me take this question. I think interest rate cycle going forward, if you see, for US, it was expected to be 4.25 to 4.5%. And now they are talking about 5 to 5.1%. So you can expect another 50 to 75 bips of interest rate increase in the coming meetings. So another meeting we have in US, which is towards the end of February. And then I think what was happening before, 75 bips of rate increase. Then we saw 50 bips of rate increase. It is possible you may see 25 bips of rate increase. So that trend is declining actually, and that is seen in India also. which was already doing better. So I think this is what is going to there. And our bond yields have not moved up. From May 2022, we saw when 190 bips of rate hike happened, our bond yields remain around 7.5%. But in that period, the US bond yields actually had moved up. So their equity markets tumbled, but our equity markets remain resilient. That was one of the reasons. I am getting another question on IT space. What is your view on IT sector? So I think it's very interesting now because IT space has come down, and we have seen substantial correction. Some of the mid-cap stocks actually have come down to almost half. Large cap stocks which were at 31 price to earning, they have come down to 22, 23 price to earning now. Their base case valuation used to be around 19 times. So they are 15% higher from those base case valuations, or 20% higher. The thing is, I think the commentary which is going to come now, that is very important, because globally, what commentary we have seen, it is not very encouraging because of the slowdown scenario. If you look at Accenture, which used to grow around 15%, they have given the guidance of 8-11%. So it is a subdued guidance for financial year 23. So if that kind of commentary comes from IT, and second half used to be weaker actually for IT for any financial year. So I think in this quarter, if one positive is there, that their margins should start improving, because attrition rate actually should come down, which used to be 28% in Infosys. I think it should start declining, because we have seen that there are two things which have happened. First, the global layoff has been very high. We have seen it. So the movement of people from one company to another may come down. We were seeing more people were going into fintechs, and they were hiring a lot. So I think that trend also, with the higher interest rate cycle and the funding getting costly, that trend also possibly may see a halt. So the attrition rate should come down. That will add to even 1% or in the margins of the large cap IT. So large cap IT looks better to us. We are still waiting. We have not increased our weight in the portfolios. We are now at weight actually in IT. If you look at in our portfolios, we are not overweight yet. So we are just waiting, but we are more sticking with the large cap IT so far. So that is all from my side. Thank you very much, and have a very good 2023 year for you, for your family, and have a very good investment going forward. Thank you very much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.